Welcome to Moffat and Money. I'm Clay Moffat, and I'll be with you here today. Glad to be with you here today. Hope you all had a great Christmas and are looking forward to a great New Year as well. Now, today we're going to be talking about FTX again. It's a hot topic. Get a fair amount of questions on it. So today we'll be looking at one of the bankruptcy filings by the new CEO of FTX, John Ray, in which he details the financial condition of the companies involved. And there's a ton of them. But before we get started, let me ask you, if you would, please just to like, subscribe, do all those well-known, much loved, much greatly appreciated YouTube-y things. We've gotten off to a pretty good start on this channel, and we want to keep it up and appreciate your support. Now, to our favorite narcissist, the architect of the visionary accounting system that we'll describe, the manufacturer of mayhem, our fraudulent financier, Mr. Sam Bankman-Fried, or Freed, however you want to pronounce it. I will just refer to him as Sam generally. And I must say, in all honesty, he's been convicted of nothing. These are just my opinions. These descriptions of him are just my opinions, and those are based on his own tweets or text or public statements. You know, we've seen the arrogance in his effective altruism, how he manipulated those people saying what they wanted to hear so he could get the access he wanted, the influence he wanted, the money he wanted. We've seen his disdain for investors and creditors, running such a shoddy business while he publicly, pretentiously pretended to be a paradigm of virtue to the world at large through the media. Now, he even proposed to regulators that FTX ought to be the model. He came up with a series of recommendations, crude recommendations, admittedly, but a series of recommendations that he wanted regulators to implement as a series of regulations that would basically end up favoring FTX or FTX's model. So this guy really had no lack of, what's the word I'm looking for? No lack of hubris, perhaps. Hence, narcissist. He just thought that he was all that plus some. Now, with regard to accounting mysticisms, his innovations for FTX. I already mentioned John Ray, the appointed CEO, who's overseeing the bankruptcy administration. And this guy has a stellar track record as far as handling bankruptcies. He started with Fruit of the Loom in the late 90s. He then was the director or appointed CEO of Enron during their multi-year long bankruptcy proceedings, in which he stated he returned 52 cents on the dollar to creditors, which is a high rate. I doubt we'll see that high on FTX's creditors, investors, but we can hope. But right now, it's honestly very vague. I'll just leave it at that. He's also overseen the Nortel, the residential capital bankruptcy, a very large real estate firm that folded during the subprime crisis. All of this. And he's now handling FTX, a system which he stated was handled by QuickBooks. The accounting system used was QuickBooks. Now, I don't know if you're familiar with QuickBooks, but it's basically a PC computer accounting system, and not disparaging QuickBooks at all. It's a great little system for small businesses, mom and pop businesses, a few employees, but it was not designed to handle the accounting needs for a $15 billion corporation with thousands of employees and millions of investors. It just is not. Using it in that climate and that environment is kind of like trying to put out a forest fire using a handheld fire extinguisher. You may have a great handheld fire extinguisher, but it's just not the right equipment for the job. QuickBooks, there's no way it could handle the load required for such a business of that magnitude. Now, what we're going to do is Ray filed a declaration called, let's see, Chapter 11, Petitions and First Day Pleadings. So we're going to walk through that. And, I'm not an attorney, so I'm not going to comment on the legal aspects. But in that pleading, he listed some financial statements and made some interesting comment about the finances of FTX and the accounting system. And so that's what we're going to highlight and try to hopefully, put in a clear nutshell kind of version so you can better understand what the problem is with the FTX books. Now, to the filing. I'm just going to enlarge this so that it covers the whole screen. So you can see it a little bit better, I hope. Now, here's the page, and just a little technical term. Ray is the chief executive officer of FTX for the bankruptcy court, and he refers to FTX and all the subsidiaries, and there's a bunch of them, as debtors, the debtors. So you'll see that term throughout. He's just referring to FTX, the bankrupt companies that he's overseeing. Okay, so as we go through, he makes a couple of fascinating statements. First of all, he starts off declaring his background publicly. 40 years of legal and restructuring experience, chief restructuring or CEO for several of the largest corporate failures in history. Okay. He's handled allegations of criminal activity and malfeasance. He's supervised novel financial structures, cross-border asset recovery and maximization. Nearly every situation in which I have been involved in has been characterized by defects of some sort in internal controls, regulatory compliance, human resources, and systems integrity. Great background. Now, how does that frame his view on FTX? Next paragraph. Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here. From compromised system integrity and faulty regulatory oversight abroad to the concentration of control in the hands of a very small group of inexperienced, unsophisticated, and potentially compromised individuals. This situation is unprecedented. Hell of a statement. Now, what does all that mean? Well, we're going to spend the next few minutes detailing exactly what lies behind those statements and what those statements mean. So let's start with the petition, the corporate organization. What Ray has done is take all the subsidiaries, divisions, whatever you want to call them, of FTX and lump them together in 4 different groups. Each group he calls a silo. Now, the first silo is WRS, and here he states it includes the businesses known as FTX US, LedgerX, some of the other divisions. We're not going to detail all the embedded firms in each silo. It really doesn't contribute to the points we're trying to make here, but just know that each silo is just a group of similar businesses, same business area. So the 4 silos are WRS, Alameda, Ventures, and .com. Mr. Ray makes it clear that each of the silos was controlled by Mr. Sam. We'll detail that, how he controlled those later, but he sums it up nicely here. Minority equity interests were held by Wang and Singh, co-founders. The WRS and .com silo also have third-party equity investors, including investment funds, endowments, sovereign wealth funds, and families. To my knowledge, no single investor other than the co-founders owns more than 2% of the equity of any silo. And to me, that's interesting wording. To my knowledge. That just simply means he is not sure. he's not absolutely confident of who owns what or how much. That ought to give you a really good idea of the state of the books, of the information available to him as CEO now of FTX. He can't even ascertain for sure, with great certainty, who owns what and how much. So he says, to my knowledge, to the best of my knowledge, what I've been able to find out so far, no single investor. Again, that's an amazing statement. Now let's look at the different silos. We'll start off with WRS. Mr. Ray details how, according to Sam, he had approximately 1 million users as of August 22. Now remember, they were using QuickBooks. With how many thousands of employees, how many, different offices or whatever, there's just no way QuickBooks can handle that kind of diversity or load. Not what it was designed for. But that's what they had. So here, Sam says they have over 1 million users, basically at least 1 million different accounts to keep track of. Keep that in mind. Now, WRS Silo owns, this is an important point, Silo owns 100% of the equity interest in LedgerX. Now, LedgerX is a legitimate company, well known. They make the cold wallets that a lot of people use to store their crypto in. And some of you may ask, what's a cold wallet? Well, if I use like a bank, Wells Fargo, BOA, Chase, Citi, whatever, I can go online and look at my account and see the amount of money in my checking account. Or I can use stock exchange, Merrill Lynch, Ameritrade, Robinhood. Same way, I can go online and look at the number of stocks and the cash in my account. Well, for crypto, you can go online to certain brokerages or exchanges and look at your account. Same way. That's called a hot wallet. Your money is stored online. It's possible with crypto to actually download your coins to, it's basically a jump drive. Jump drive contains the keys and the code to transfer your money, your coins, to any other account that you want to. So you can't do it online. You have to plug that in order to access your money. That's a very safe way of storing crypto that a lot of people use, because as long as you've got that drive, nobody can steal it. If somebody does steal that drive, they won't know the codes and the passwords, hopefully, and so it's useless to them. So you can reconstitute that drive and that information with your particular passwords and codes. It's not terribly complex, but it's definitely not simple per se. But it's just a way of you storing your coins on a jump drive. Cliff Notes version there. Well, LedgerX is a big, extremely well-respected manufacturer. They also have an exchange where they are licensed by the various regulatory agencies to trade futures and crypto and other things. So a legitimate firm. Here, Ray makes a statement, LedgerX is solvent. So to me, that implies that LedgerX is not a part of the bankruptcy proceedings. Even though Sam made an investment or purchased a portion of them, I'm not exactly sure of that arrangement. I haven't seen the contract, but he wasn't involved enough to screw it up. So later on, Ray refers to LedgerX as a non-debtor. So it makes me think they're really not a part of his administration. So there are some legitimate firms involved in all of this. So we have to be careful about labeling anybody connected or any firm connected with FTX. Now, looking at the silo, there are financial statements that were available to Mr. Ray, and he's published them here in this report, and that's really what we're going to focus on. But there's some fascinating things about these statements. Looking at WRS Silo specifically, shows 1.36 billion in total assets as of that date. Now, the date, September 30th, 22, this was, 2 months before the bankruptcy. But Ray makes a statement. He says, because this balance sheet was produced while the debtors were controlled by Sam, I do not have confidence in it, and the information therein may not be correct. Hell of a statement. I remember Sam. I remember Sam talking about how FTX was audited. Well, these are the financial statements that were quote unquote produced by the audit. And, you can look at the numbers. They may not make necessarily a whole lot of sense, without context. If you've looked at financial statements, and I've looked at thousands of them down through the years, you end up paying more attention to the footnotes a lot of times, because in the footnotes, there is detail contained that really they don't elaborate on in the public section. It's always the fine print where the devil in the details is hidden. So if you pay much attention to financial statements, you'll get very interested in the footnotes. So following the footnotes here, we see this asset listing for WRS Silo. And there are really two kind of numbers that jump out to us. Loans receivable. Okay. Remember, Silo contains FTX and was a trading platform. So why would an exchange be making loans? One question. Second thing is restricted cash. That could be cash in specific customer accounts. Ray has already indicated he's uncertain of some of the amounts. So we're like, okay, what's going on here? Well, let's go to the footnotes. Footnote 3, restricted cash at the WRS Silo is primarily comprised of approximately $250 million in restricted funds at non-debtor Ledger X. Okay, Ledger X has the 250 and it's not really a part of the proceedings, if I understand the word non-debtor correctly. So that's the bulk of the 267,738. Now, here's the fascinating statement. Balances of customer crypto assets deposited were not recorded as assets on the balance sheet and were not presented. That's a fascinating statement for an exchange, because to give you an idea of what he's really saying here, if you take $1,000 to the bank and deposit it at the bank, that's your money. That's your asset. And the bank knows this. So they set up a special account, a unique account with you as the signatory, the signer. It's in your name, your social security number, everything is solely connected to you. If you move money out of that account, they reduce the amount in that account, open you up another account if you buy a stock or whatever with it, so that it's always your money and credited directly to you. To the bank, when you deposit $1,000, they take that in as cash. Of course, cash is an asset to the bank, but they also create a liability because they owe you that $1,000. That is a liability to them. So in accounting systems, you have an asset and you have a liability for each transaction, liability or equity. And so they increase cash by 1,000 and they increase liability by 1,000. So the net change to the bottom line is zero. The bank has $1,000 in cash. They owe $1,000 in cash. Well, and the bank multiplies that by, hundreds of thousands or millions of depositors, everybody with their own unique number. Well, what Ray is saying here is that information's not available. So it appears that FTX basically took your $1,000 and put it with $1,000 of thousands of other clients into one big pool, but didn't keep separate track of each individual's money, their contribution, or where it went. That's fascinating. Absolutely amazing. Balances of customer assets deposited were not recorded as assets. And when we get to the liabilities, you'll see they're not recorded as liabilities. So what'd they do with it? That's going to be the key in figuring out FTX's financial statements. But wait, there's more. This shows a loan receivable of $250 million. All of this is in thousands. So 250,000 actually becomes 250 million. So loans receivable of 250 million consist of a loan by West Realm to BlockFi of 250 million in FTT tokens. Well, that's the bad news. Because if you look at FTT, back when this loan was made, FTT was probably selling at around $40 a token. At its high, FTT was 85 a token. And it was only around for a year or so. But if we looked at the value today, it's at 93 cents. That's like a 97, 98% drop in value just in 6 months. Here we see it, declining, going down. Now, this is interesting. On the 4th, it was 25.55. Well, on the 5th, it dropped. By the 6th, it already dropped $2. Relatively steep. This is probably a sign that insiders, that people who knew that what was going on, were dumping some of their tokens. And then boom, on the 7th, the announcement that FTX is declaring bankruptcy, it drops to, what did it hit? 231. It bounces up a little bit. Don't ask me why, but bounces up a little bit and then has continued working its way down to the current 94 cents. Think about it. If somebody owned FTT and the company that issued it declared bankruptcy, the only exchange that traded it declared bankruptcy, why would you hang on to it? It just, there's really, in my humble opinion, which is worth what you pay for it, there's really almost no chance that this coin regains significant value or any real value. It will probably just go kaput. There are over 2,000 crypto coins, and the vast majority of them are going to die. This one is comatose and on a respirator, laboring to breathe. So I don't know why anybody would be hanging on to it, but I wish them much luck. So, the loan receivable, you can basically take this loan receivable and take it to zero, because BlockFi, when FTX collapsed, went bankrupt, it also declared bankruptcy. No shock. They lost $250 million of their capital and assets, just absolutely vaporized. So they had no choice but to declare bankruptcy as well. So interesting, financial statements, some interesting, fascinating comments there in the footnotes. Mr. Ray continues. He talks about the debtors are expected to have significant liabilities arising from crypto assets deposited by customers. Remember me talking about bank deposits? Same thing. Customers deposited assets or crypto in the FTX platform. Here's the money quote. Such liabilities are not reflected in the financial statements prepared while these companies were under control of Sam. Can you imagine your bank not keeping track of how much money you deposited, you and a million other depositors, and where that money went and who was owed what? Yeah, this is just an absolute train wreck, complete and total train wreck. Here's in the footnotes, we immediately head to the footnotes. Customer custodial fund liabilities are comprised of fiat customer deposit balances. So they deposited a currency. Balances of customer crypto assets are not presented. They're not presented because they don't have the information. They don't know what to present. They don't know how much to present. They don't have the records. Simply amazing if you think about it. I don't know if any of y'all are investors in or own FTT or were investors with the token, but my heart goes out to you if you are. It's not looking good. All right, let's take a look at another silo, another group of firms, Alameda. Okay. Interestingly, Alameda was the first company started before FTX, which is organized in the state of Delaware. So it looks like, they tried to do a normal incorporation. Now, Ray details that Alameda operated a quantitative trading fund specializing in crypto assets. Strategies included arbitrage, market making, yield farming, and trading volatility. Now, to me, those are very low quant strategies or positions. I'm trying to think how I want to word this. Those are actually just pretty common functions for a exchange. So looking at each one, arbitrage, big fancy word. What's arbitrage? Arbitrage technically is exploiting a price differential in two separate markets simultaneously without risking your own capital. Now, what do I mean? So what does arbitrage mean? Arbitrage is simply seeing an asset traded in two separate places and the prices are different. So you buy the low, you're able to buy it low and sell it at the high price. And you profit from that difference in price. And you keep doing that until the prices equal out. Now, technically, or in a practical sense, that would work with something like, say, Mercedes-Benz. Mercedes-Benz is traded on, I believe it's the Stuttgart and the Hamburg exchanges, as well as it has an ADR listed on the New York exchange. ADR is American Depository Receipt. And ADR is just simply a trust that's established, goes out and to Stuttgart and buys Mercedes-Benz shares, maybe 1 million shares, and then issues 1 million of these ADR receipts. And people will trade these ADRs just like the stock. It's a way for Mercedes to trade in different markets around the world, in the US anyway, without having to go through the expensive and extensive filing requirements to get listed on a stock exchange. So it just simplifies the process. So it's just like owning the stock. You've got a legal claim to a share of the stock. So if I saw Mercedes trading at a cheaper price on the New York exchange versus the Hamburg exchange, taking into account, the currency exchange rates, then I could buy it on the New York, turn around and immediately sell it on the Hamburg exchange. That would be arbitrage. I could do it instantaneously and lock in that difference in price. So that's arbitrage. Nothing really terribly complicated about that. If you remember, we detailed that in the earlier video for the kimchi premium, where Bitcoin was selling at a higher price in Korea and Japan. You could buy it cheaper in Hong Kong in the US, then turn around and sell it in Korea. Market making is just a normal function of trading any asset, stocks, bonds, futures, whatever. A market maker is simply think of it as a broker who maintains an inventory. A broker just arranges the trade. The asset doesn't pass through him. A market maker actually has inventory of that asset. So he buys for his account, he sells out of his account. So he is a true middleman. He will own the asset. That's the difference between a market maker and a broker. So a market maker is responsible for maintaining the price. If you look at a price for a stock, you'll have a bid and an ask. You buy it at one price, you sell it at the other. So the market maker establishes those two prices, the bid and the ask, and he maintains the inventory. If supply of the stock gets a little low, he'll sell out of his inventory to try to maintain a stable price. If demand gets low, he'll buy into his inventory to maintain a stable price. That's what they're kind of legally required to do. So that's a market maker. There's nothing unusual or quantitative about that. Yield farming is just simply, finding money at a low price and lending it out at a high price. Again, nothing terribly sophisticated about that. And trading volatility. Volatility is the variation in a stock price. Like some stocks barely move. They just, let's say, slowly rise over time. Other stocks bounce up and down a bunch. There's great variation in the price, even though over time it still moves upward. That's volatility. That's high volatility versus low volatility. Really, today, there are two main factors in trading. There's volatility and momentum. Momentum is simply a directional movement in price that gains strength, increases momentum. Think of it as a snowball rolling down a hill, and the snowball picks up more snow, it picks up speed, it becomes harder to stop. That's momentum. Volatility is if that snowball is rolling down a rocky mountain and bounces a bunch. It's still heading down. It's still got momentum, but it bounces a bunch on the way down. Low volatility would be a very smooth mountain, and there was just a linear, a straight line movement in the snowball's direction. So again, there's nothing terribly sophisticated or complex about any of those. I wouldn't really describe those as quant specialties. However, that's really the only thing I possibly could disagree with what Ray describes. But he goes on and he talks about how Alameda was owned 90% by Sam and 10% by Wayne. Okay, we kind of already knew that. Then he talks about the balance sheet, again produced September the 30th, but it shows 13.4 billion in total assets. Again, we have this amazing statement because this balance sheet was unaudited and produced while the debtors were controlled by Sam. I do not have confidence in it. You know, that's again an amazing statement. Here's the listing of assets, and sorry for the split. This is just a copy of the filing, and it was actually split in the filing. Makes it a little awkward to look at, but we'll go with it because we aren't picky. So we've got this asset listing. And what's the first thing we want to head to? The footnotes. So we head down to the footnotes and we see footnote 2. In the above table, intercompany accounts receivable, accounts payable, and loans are not presented. You don't see that often. So there must be something significant going on there to where, well, one, they should be presented. They should show up in those changes of assets and liabilities that I mentioned earlier, because money value is being transferred. And anytime it's transferred, it should be recorded. But it's not recorded. They don't have the information. It doesn't show up. They can't present it. So they disclose that we can't present it. That's amazing. Why would the companies, and we know you had these, 50-ish different shell companies and whatever, all moving money around. Why would they all so actively move money around, and why have so many different subdivisions? Is there any real possible business reason for this? I mean, think of it as you get paid, or you have $1,000 come to you, and you think, well, I want to make myself a loan, and then I'm going to take that loan and make myself another loan with it, and then take that loan and make myself another loan with it. Why would you do that? Why would you do that as a company? The only reason I can think of, the only reason I've seen in my years of practice, is to hide that money, where it's going, to try to make tracing the flow of that money difficult or impossible, otherwise known as money laundering. I'm not saying or guaranteeing that's what's going on, but I have thought about this and struggled to come up with a reason. Why would any business have this many shell corporations and be transferring money back and forth and not tracking the flow of that money? I just have trouble coming up with many decent explanations. Make of it what you will. The third footnote, related party loans receivable of 4.1 billion at Alameda Research consist of a loan by Euclid Way to Paper Bird of 2.3 billion. Remember, Sam owned Alameda, which owned Euclid, which owned Paper Bird. which was owned by Sam. So remember my little example I just gave of why would you make yourself a loan and then another loan and then another loan? Well, here it is. What possible business explanation would he have? 2.3 billion. Okay. I want to know where that 2.3 billion went and why he tried to bury it. But we're not done yet because there's still 3 loans by Almeida Research, one to Mr. Bankman of 1 billion. So here's another billion. 543 to Singh, and Salome got 55 million. All loans. I wonder what their salary was for that year. Hadn't seen that disclosed yet, but that would be interesting. I'd be willing to bet they had very low salaries. So why would you hand out that much money in loans to employees? I mean, if you had parents that were tax attorneys, they might point out to you that loans are not taxable as income, whereas salaries are taxable. And at this level, you'd probably be paying 40% of your money in taxes, but you don't have to pay taxes on loans. But I'm sure his parents, being tax attorneys, wouldn't advise him to commit fraud by taking loans as salary. I mean, they raised an honest, trustworthy, responsible kid, right? All right. Almeida's liabilities. You've got assets, you've got liabilities. Now, here, not a whole lot we can comment on. The only real thing in the footnote is, again, intercompany AR, accounts payable, loans payable are not presented, which makes you wonder, what happened to that information, that data? Another interesting statement is Almeida was organized in Delaware, but the subdivisions or other companies in the silo were organized in Delaware, Korea, Japan, British Virgin Islands, Antigua, Hong Kong, Singapore, Seychelles, Caymans, Bahamas, Australia, Panama, Turkey, and Nigeria. I can understand having some subsidiaries, located in nations where business is conducted on a different level or with different personalities. For example, Japan generally prefers to do business with Japanese companies. So you might want to establish a Japanese company to handle Japanese customers. But, some of these, Seychelles, Caymans, Bahamas, Panama, all used to be extremely well known as good places to launder money. Now, some of the disclosure laws and reporting laws, there have been treaties signed and made that probably less possible, but they still have very strict disclosure requirements. And for example, in Bermuda, I can call up Bermuda and open up an account without even being there or having to sign for it. Just give them code, transfer money. They give me my account number and boom. But why would you want to establish a company, say, in Nigeria? Nothing against Nigeria, but it's not a great business environment. I don't know what the incorporation laws are or what the disclosures are. I have absolutely no idea of why you want to incorporate, a company there, particularly when you had almost no business emanating from there or Africa. But there's a story there. We just don't know it. But I admit I'm a little fascinated as hell by it. So we'll be looking to keep an eye on that. Next silo, ventures. Now, venture makes and manages private investments. Not sure who the hell what private investments are to this firm, but they have, Clifton Bay Investments, FTX Ventures, Island Bay Ventures, and other affiliated companies. Don't really describe what the hell it is, but they do have a balance sheet and it shows a total value of $1.5 billion. So it's not an insignificant little interest. Okay. The balance sheet for FTX Ventures shows another $483 million. Now, again, we've got the famous, well-known comment by Mr. Ray. To my knowledge, none of these statements have been audited. Because these balance sheets were unaudited and produced while the debtors were controlled by Sam, I do not have confidence in them. Again, it's hard to make, comments off of something that's just almost a complete myth or suspected of being a complete myth. Mr. Ray also states, I've not been able to locate financial statements for Island Bay Ventures. Interesting. Why would you put money or run money through a firm and not track it at all? Just interesting. My own observations, nobody else's. So again, with ventures silo, you have no tracking of intercompany transfers. You do have related party accounts payable, okay, which means they borrowed money from Almeida of 1.4 billion, one with Almeida Research of 68 million, and one with Ventures of 38 million. And then let's not forget West Realm, 2.25 million. So what were they doing with all this money? I'd be interested to know. Again, balances of customer assets deposited are not presented. They simply don't have the information. .com silo, the fourth one. Now, Sam claimed by the end of 21 that they had about 15 billion total on the platform, which according to him handled 10% of global volume for crypto trading. Now, Sam also claimed FTX had millions, plural, millions of registered users. Mr. Ray states, these figures have not been verified by my team. He's got his team in. He's got all the information available to him. He can't even tell you what the total assets are. He cannot represent to the court what the total assets are. He relies on a statement of Sam. Fascinating. He posts or shows us the assets of the .com silo, 2.258 billion. Again, you've got the same disclosures in the footnotes. It includes a loan receivable of 250 million in FTX loan to BlockFi of FTT tokens. Obviously, that's vaporized. He also has in this one intangible assets in the amount of 343 million are not reflected above. These consist of values attributable to customer relationships and trade measures. Intangible assets are assets which have value, but which aren't tangible, which aren't physical inventory or items or buildings. For example, Coca-Cola. Coca-Cola has bottling plants of physical and machines, physical assets. But Coca-Cola is worth more than just the value of those physical assets. The name Coca-Cola has significant value. It's like Google. The name Google has significant value. If Google offered a new product, would you buy it, or would you be willing to consider buying it just because it's Google and you trust the company? That's the value. If the company owns a patent, that's a right to produce something. They don't even have to be the one producing it. They can just lease out that right. But that patent has value. That's an intangible asset. Ray also states a goodwill balance is not reflected. Goodwill worth 359 million. Now, goodwill is simply the difference between the price paid to buy a company and the market value of its assets. Remember, I was just talking about Coke. You've got the bottling machine, but the name Coke has value. It's an extremely valuable trademark. Well, if somebody bought Coke, the name Coke would be goodwill. The value of the name Coke would be goodwill. So if we look at this, the intangible assets, for example, consist of values attributable to customer relationships and trade names. Well, how much do you think the value of FTX's customer service is worth right now? If it's not zero, it's pretty damn close to it. How about the name FTX? How much is that worth? Somebody going to invest with a company called FTX now? That probably, if it's not zero, is pretty damn close to it in value. So their intangible asset value is just vaporized. .com going on. Ray states the debtors, .com silo debtors, may have significant liabilities to customers through the FTX platform. However, such liabilities are not reflected in financial statements prepared by these companies. So again, now this is not a footnote. He's stating this in, directly and in the, I call it the big letter section. To me, this is a very clear indication that not only does FTX didn't report these at the time, it's that he can't report these now. He doesn't have the information. It should be immediately available with any decent accounting system, but he's been there for weeks and still can't give a value of the total assets in the firm or significant liabilities owed to customers. That's amazing. Simply amazing. If you're an FTX investor, again, that's got to be just depressing. Again, they've got the statement: balances of customer crypto assets deposited were not recorded. You just are, you've got to be shaking your head by now thinking, what the hell were they doing? That's the $1 million question, or $15 billion question, actually. Going on down, looking at some of the other statements, Mr. Ray has appointed or selected, signed up, however you want to word it, an independent board of directors. And, he lists them, several fairly well-known, very respectable individuals. And then he makes this statement: the appointment of the directors will provide the FTX group with appropriate corporate governance for the first time. What's he referring to there? Well, what he's basically stating is that prior to the bankruptcy, the board of directors for FTX consisted of Sam and Salmi, the CEO. There was no independent board overseeing the $15 billion company. It was all Sam. Sam controlled everything. He had no accountability. He reported to nobody, had nobody overseeing the business. And theoretically, that's the idea or the notion behind having a board of directors, an independent board of directors, is that they should represent the shareholders' interest. So they should be holding management accountable. That's the role of the board of directors, is to oversee the performance of the CEO from a shareholder perspective. And there was none of that in FTX. So you want to know the companies not to invest in, you want to know companies not to put your money with, well, you probably don't want to choose one that doesn't have an independent board of directors. Just saying. Cash management. This is fun if you're not an FTX investor. The FTX group did not maintain control of its cash. Cash management procedural failures included the absence of an accurate list of bank accounts and account signatories. Boom. Right there, he says, we don't know who has what in their account. We don't even know who they are, maybe. As well as insufficient attention to the creditworthiness of banking partners. So basically here he's saying they put money with firms that they may not be able to get money out of, that they're not credit worthy. Amazing. Simply amazing. Why? Sam wasn't an idiot. Very well respected degree. Singh is not an idiot. Wang is not an idiot. These were intelligent people. So why would they run such a shabby company with such mystical accounting procedures when they didn't know where the money was going or who it was owed to? There's a reason why. I can't specifically say what that reason why is because I don't know for sure. But if I had to guess, Ray goes on and points out that cash that the debtors were able to locate will be deposited into financial institutions in the U.S. that are approved depository institutions. So he's taking whatever cash he finds and is transferring it to U.S. banks registered with the comptroller of the currency or state regulatory officials, whatever. But it's probably the large global banks, probably the primaries like Chase, Citicorp, Bank of America, these kind of banks. So he's moving the money to places that he knows is relatively safe. Now, because of historical cash management failures, the debtors do not yet know the exact amount of cash FTX Group held as of the petition date. The petition date is when they declared bankruptcy. So here he is, a week later, stating, we still don't know how much cash we've got. Here is what he describes as an approximation. To date, it has been possible to approximate the following balances, but they're still not sure. So out of a $15 billion corporation, he's got roughly $500 or $600 million in cash that he can account for. That's about 3%, 4% of the assets of the firm. Mr. Ray goes on. He states, effective cash management also requires liquidity forecasting, which I understand was also generally absent from the FTX group historically. Now, liquidity forecasting, that's just kind of a fancy word for knowing when your bills are due. Like as an individual, you liquidity forecast when you know that at the end of the month, you've got your power bill, your gas bill, your water bill, your rent, you need money for groceries over the next couple of weeks, that kind of thing. So you need cash available to pay those bills. You need that liquidity available to pay those bills. Well, FTX didn't do that. They didn't know what the bills were, what was coming due. They didn't try to manage their cash so that they could meet their obligations. They didn't do any of that. They would just have a bill due. Sam would basically authorize it out of some lump pool of money and take care of it. Fascinating. Now, here's a fun part, the financial reporting. Ray states the FTX group received audit opinions on consolidated financial statements for 2 of the silos. Remember, there were 4, WRS and .com, for the period ended December 31, 2021. The audit firm for WRS was Aramino or Aramarino, whatever, a firm with which I am professionally familiar. He doesn't say another word about him. Interesting. The audit firm for .com was Prager Metis. And get this, a firm with which I am not familiar and whose website indicates that they are the first ever CPA firm to officially open its Meta Universe headquarters in the metaverse platform Decentraland. Seriously, I did not make this up. This is the filing. So were they Meta audited? I don't know. But there's a reason why Ray, after every financial statement, had the statement, these were done under Sam. We have reason to believe they are not accurate, and I would not place any confidence in them. Ray even states, I have substantial concerns, substantial keyword, as to the information presented in these audited financial statements, especially with respect to the .com silo. As a practical matter, I do not believe it's appropriate for stakeholders or the court to rely on audited financial statements as a reliable indication of financial circumstances of these silos. So he's basically saying, I don't trust either one of these firms. I don't trust either one of these audits. He adds, the debtors have not been able to locate any audited financial statements for Alameda or Ventures. Why would $15 billion corporation, why would they not have proper accounting and audits for the operations of 2 of the major areas or exchanges? Why would you not want to know where your money's going if you were running a legit business? Interesting. But we're not done yet. We still have more. So here Ray makes a statement. The FTX group's approach to human resources combined employees of various entities and outside contractors with unclear records and lines of responsibility. The debtors are unable to prepare a complete list of who worked for FTX as of the petition date or the terms of their employment. Repeated attempts to locate employees to confirm their status have been unsuccessful to date. This is just absolutely crazy. You've got a $15 billion firm with thousands of employees, and you don't know who you employ. You don't know how much they get paid. You don't even have a complete list of them. You don't know what they're responsible for, what the terms of their employment are. And if you try to get a hold of them, you can't. How cool is that? Absolutely. How cool is that? Ray makes a statement. He says there is a core team of dedicated employees at FTX who have stayed focused on their jobs during the crisis, whom I've established appropriate lines of authority and working relationships. He goes on and states, I am thankful for the extraordinary efforts of this group of employees who, despite difficult personal circumstances, have risen to the occasion. and demonstrated their critical importance to the debtors. So I just wanted to give, some of the good people their props and not taint everybody that's connected with FTX or, like LedgerX, a good, reliable, solid company, as far as I know, has a good reputation in the industry anyway. Don't want to broad brush and paint everybody that was with FTX as a fraud or concealing fraud or covering up fraud. Like any major bankruptcy, Enron or whatever, there were a number of employees that had no idea what actually was going on. They lived in a contained world. They just knew what they were doing and had no real idea. So just want to, give them the good people their proper credit. Another cool section. We're not done yet. Disbursement controls. Now, the debtors did not raise states. The debtors did not have the type of disbursement controls I believe are appropriate for a business enterprise. For example, employees of FTX submitted payment requests through an online chat platform where a disparate group of supervisors approved disbursements by responding with emojis. They submit requests through a chat platform. I don't know what chat platform. And their request for reimbursement was approved with an emoji. That's pretty cool. It sucks as a business practice, but if you're hip and with it, that might be the kind of company you want to work for, at least till it goes bankrupt. Now, in the Bahamas, Ray goes on. In the Bahamas, I understand that corporate funds were used to purchase homes and other personal items for employees and advisors. One employee in particular, or a couple of employees in particular, but I digress. Ray states, I understand that there does not appear to be documentation for certain of these transactions as loans, and that certain real estate was recorded in the personal name of these employees and advisors on the records of the Bahamas. So some of the money going to Sam, he stated were loans. Well, there's no record of it being as a loan. I would assume he did not report it as salary. I'm sure the IRS might be a little interested in that. Hello, IRS. And that he took that corporate money, stated was a loan, and then he bought property with it, but he bought the property not in the company's name, but in his name or in his parents' name. They owned, what was it, a $4 million property in Bahamas? He was living in a $40 million condo. Amazing. Just absolutely, where did he get his tax advice from? What made him decide to do it in this form? I have no idea. Looking at a few other comments, FTX Group did not keep appropriate books and records or security controls with respect to its digital assets. You'd almost think based on this statement that maybe FTX kept appropriate books on something, but I really doubt there's anything at all they had appropriate records of. Sam and Wine controlled access to digital assets of the main business. Unacceptable management practices included the use of an unsecured group email account as the root user to access confidential private keys and critically sensitive data. Now, basically what this means is that somebody, the root, manages the email account. So for all the employees, all the transactions, all the customer requests, et cetera, this person has the ability to see every email, view every email, to perhaps even access private keys and passwords used to access accounts. So this root person that had no security, the group email account was completely unsecured, not safe. Anybody could have, who was aware of that, who tried, could have hacked into it with ease. There was an absence of daily reconciliation of positions on the blockchain. With blockchains like Ethereum or Bitcoin, the reconciliation is instantaneous. Anytime you buy a coin, you move cash out of your account to buy a coin, that is immediately reflected. It is called a reconciliation. The balances are kept current. Well, apparently FTX didn't believe in keeping accounts current. So, not even daily. At the end of the day, they didn't balance out everything like banks do. Don't know if they did it at all, actually. Ray states the use of software to conceal the misuse of customer funds. Boom. I mean, some people wonder how the SEC could file fraud charges so quickly. And I'm like, what took them so long? There is some of the failures to track customer funds is highly illegal. I don't know how to describe it. I don't want to get into the legal aspects, but it's a no-brainer. How's that? It's a default. Should be just a default judgment. Come in, present the evidence, the judge finds them guilty and hangs them. I won't say that, but actually I just did, didn't I? Let's just delete this. The use of software to conceal the misuse of customer funds. Well, boom. Bray just points to direct fraud there. He also talks about the secret exemption of Alameda from certain aspects of FTX auto liquidation protocol. Now, I talked about this in the last video. The auto liquidation protocol refers to margin calls. If you buy a stock, a dollar stock, you can borrow money to buy it. If you only have 50 cents, you can borrow 50 cents to buy the $1 stock. Well, if the next day that $1 stock drops to 80 cents, that's a 20-cent loss. Well, that doesn't come out of the amount you owe. You still owe 50 cents plus interest. So that comes out of your capital, your equity, your 50 cents. So your 50 cents is now worth 30 cents. Well, the exchange may want you to keep a 50-50 balance. So they call you. They literally call your phone, and it's called a margin call. And they'll tell you that you need to either cough up another 20 cents to bring your balance back to 50-50 or they'll close out the account. And so you say, I don't have any more cash, so let's go ahead and close the account. So they sell the stock for 80 cents. They take their 50-cent loan and interest out and give you whatever's left. And of course, you have 30 cents or less, including the interest that you had to pay. So you took that loss. Okay. Margin call. Well, that's the auto liquidation protocol. And Alameda had an exemption from FTX against margin calls. So no matter what position Alameda took, and no matter what happened to the price, they wouldn't get a margin call. That isn't kosher, according to the SEC. It's just flat out illegal. So that's another fraud. The absence of independent governments between Alameda, owned 90% by Sam and 10% by Wang, and the .com silo in the third parties he'd invested. So you've got all this money going between different accounts that Sam owns and controls. There's no governance. There's no oversight over that. That's a problem. Now, interestingly, Ray states they've located and secured only a fraction of the digital assets of FTX they hope to recover. They hope to recover in these cases. That's not promising. The debtors have secured in new cold wallets approximately $740 million of crypto that the debtors believe attributable to the different silos. Debtors have not been able to determine how much of this crypto is allocable to each silo, or even if such an allocation can be determined. So they've recovered $740 million in crypto. They just have no idea who owns it. Amazing. Simply amazing. These balances exclude crypto not currently under the debtor's control as a result of at least 372 million of unauthorized transfers initiated on the petition date. Remember, the petition date is the bankruptcy date. And on that date, somebody with the passwords entered into FTX's system and transferred 372 million worth of cash or crypto and purchased Ethereum, one of the popular, well-known crypto coins. They don't know, quote unquote, who did it. But from previous discussion in this petition, we know who had all the passwords, and we knew who knew FTX was going bankrupt. You just follow the money. I don't know how well they'll be able to follow it, but don't have a hard time guessing or narrowing down the pool of people who could take advantage of that situation. Also, for some reason, there was minting of approximately 300 million in FTT tokens by an unauthorized source after the petition date, and the failure of the co-founders to identify additional wallets and other assets. So two things here. One, remember, FTT was a CeFi currency. One computer handled the production of it. So for some reason, this computer minted an additional 300 million of FTT after the bankruptcy. Ray's not sure why. That obviously would reduce the value of the currency. Secondly, the failure of the co-founders to identify wallets believed to contain debtor assets. So Ray is clearly stating that Sam and Wang had money stashed away that they did not declare. Interesting. Don't know how much, but that's obviously something we want to track and follow as it goes along. We're not done yet. There's still more. In terms of FTX, Ray states they had billions in investments other than cryptocurrency, as suggested above. However, the main companies did not keep complete books and records of their investment and activities. Why? Why the hell, if you're running a business, do you not want to know where you're spending the money and what you're getting for it? Since when in history has any legitimate business owner not wanted to know that? So what reasons would you not want to know that or be able to document that? Interesting. Now, Ray states they are trying to create balance sheet and financial statements as of the bankruptcy date. The debtors are doing so from a bottom-up approach. So what they're trying to do is get like confirmation statements mailed out to investors or creditors, or work with correspondent banks and determine what amounts were transferred and to who, for what reason. So they're trying to get the lowest level receipts they can and see how much of the balance sheet, the cash flow, the income statements, etc., how much of the customer accounts they can recreate from this, gathering these scraps of information wherever they can. It will be a tedious, slow, and expensive process. I can guarantee you that. Don't know how long, don't know how much, don't know what they'll be able to piece back together. But that's apparently the only alternative left to them. It's not something that you want to try to do. Ray makes another interesting statement. I mean, this filing is just full of them. But he states one of the most pervasive failures in FTX in particular is the absence of lasting records of decision making. Sam often communicated using applications that were set to auto-delete after a short period of time and encouraged employees to do the same. So why the hell would you want to run a business in which you wanted no record of any comments or discussions? Why? Again, I can only think of one reason. You would hate for some of those statements and discussions to come up in court. Amazing. Another statement here. Debtors have cryptocurrency, digital assets, and other critically sensitive data in repositories in storage, let's say, that have been subject of unauthorized attempts to access. The debtors have been advised that attempts to access this property of the estate may create a risk of its loss to unauthorized persons. I haven't seen this discussed, but what data they do have, wherever it's stored, on whatever computer or hard drive, wherever it's stored, somebody has been trying to access that, and Ray has been advised that they're trying to access it to delete it. Interesting. Not any other detail, but to me, a simply amazing statement that has gotten very little coverage, along with the fact of hidden wallets. Why would you want to hide money that was the company's? And what reason would anyone have to want to delete any trail to those wallets? Who could do that? Who would have the notion or the information to know where the data was stored and the old passwords to access it? Interesting. Ray also states he's unable to create a list of even the top 50 creditors. The books are so bad, he can't pick out the people he owes the most money to. Can't do a top 50. The record keeping is so bad, or just doesn't exist. Finally and critically, the debtors have made clear to employees and the public that Sam is not employed by the company, does not speak for them. Sam continues to make erratic and misleading public statements. Sam, whose connections and financial holdings in the Bahamas remain unclear to me, recently stated to a reporter on Twitter, "F the regulators, they make everything worse," and suggested the next step for him was to win a jurisdictional battle versus Delaware. If that isn't John Ray saying, "Bring it on," I don't know what is. Just an amazing set of disclosures and statements in this filing. This is not your normal bankruptcy filing. Now, here's just a brief chart submitted by Mr. Ray of the 4 different silos and the assets listed by silo, or the lines of business maybe listed by silo. So that's just, a little bit additional information. And then he shows the organizational chart for FTX and Bankman's Holdings. Now, if you blow this up a little bit, maybe you can see that a little better. He doesn't necessarily or in great detail give the percentage of ownership, but we know, for example, Almeida was 90% owned by Sam. This little corner over here is Paper Bird. I love that name, Paper Bird. It was 100% owned by Sam. And then Paper Bird owns 80% of these companies and FTX Trading. The list goes on. So why would you create, and this is only in 2 years of being in existence, a little over 2 years. Why would you create this many companies, firms in different jurisdictions, et cetera, and then do all sorts of intracompany loans, just have completely worthless record keeping? I don't know. I just, it's like Ray said, in 40 years, I've never seen anything like this. Blue Ridge Limited in Antigua, Strategy Arc Collective, Cottonwood Grove, Hive Empire. Gotta love some of the names. Cardinal Ventures, Euclid Way. Did he really name something on the street he lived on? I don't know. Just absolutely absolute collection of garbage of information available for this firm and the organization. So that's the overview. Hope you found it of some interest. There's still a lot more to come with all this, so we'll try to keep an eye on Ray's future filings, his financial disclosures. There's just a huge story to tell here, and it's going to be told over time, but it should be fascinating. So tune in, subscribe. If you like, give us a like. If you don't, give us a like anyway. We'll take it. Also, if you have some ideas or suggestion for future discussions, feel free to post a comment below or send me a message on Twitter. I'm sitting here stuttering, trying to remember what Twitter is called. So send me a message on Twitter, Moffat on Money. Also follow me on there, if you will. I appreciate your time. My time is up. I thank you for yours.